Recently, I attended the City Global Property Conference and I got to meet roughly 20 REIT management teams. Now, I didn't film all my interactions with them, but I had my intern with me and he filmed some short clips where I would ask the CEOs of various REITs why should investors consider buying their stock today. I put a compilation of all these discussions together and I hope you enjoy it. If you do, please consider liking this video and also make sure to stick till the end of this video because towards the end I'm going to share which one would be my top pick out of all these REITs today. Hey, this is Hersha. I'm at the City Global Property Conference today with the CEO of Unibail and just wanted to ask you, why should investors today consider investing in your company?
So our Unibail Rodamco Wastefield is a company made of incredible assets. We are not a country player, we're a city player playing in different cities, large cities, wealthy catchment areas. We're in retail, we have retail real estate, and we are, I think, one of the best developer, operator, and as well, you know, asset manager of assets in Europe and here in the US.
Yeah, and one quick follow-up question, if I may. I've seen that your company is trading at a large discount to its net asset value. And how do you feel about your valuation today?
So we're working hard to, having the investors better understanding, the quality and the intrinsic value of our, business. I think that there was a lot of questions around the future of retail and physical retail. COVID has helped understanding the fact that, physical retail is the cornerstone of the profitability of retailers in an omni-channel world, and they had this drive-to-store strategy. So I think that's just a moment in time where investors will start to get this. Plus the fact that other class of assets like offices, warehousing, even residential are under a higher level of pressure these days. And the repricing that we have seen in our business in class of assets will somehow make our company much more attractive for the months to come and the years to come.
Why should investors consider investing in your REIT today?
Sure. So when you think about Realty Income, you think about a sleep well at night story. One of the ways that we've illustrated that over time is, the fact that we have very low beta. The fact that when you think about total operational return on an annual basis, hasn't been a single year since 1994 when we went public that we've had a negative operational return. What do I mean by operational return? It's dividend plus AFFO per share growth. So everything that's in our control, we feel like, we've done a great job over the last 28 years being public as having, very good returns with very little downside risk. That's number one. Number two, we're constantly redefining the business here at Realty Income. And as many of our supporters may have noticed over the last few years, we've certainly created new verticals of growth. This past quarter, we talked about several of them. Number one was the closing of the Wynn Boston Encore property. And, that was a $1.7 billion deal. It was the first transaction in the gaming sector for us, clearly a new vertical. We also got into the vertical farming industry with a strategic alliance that we announced with Plenty, which is an operator of vertical farms that really tap into technology to solve a real problem, which is, the growth of produce and crops in a world where water is more limited than ever, availability of arable land is more limited than ever.
I'm here at the City Global Property Conference with Paul Tam, who's the CFO of CapitaLand, which is, I believe, the biggest asset manager in Singapore, right?
One of the largest.
Yes, sure. And why do you think investors should consider your stock today?
Well, I think, the fact that we are a Singapore-listed stock, as you mentioned, there are not a lot of us in Asia. And, we've had good growth over the last few years. We've seen a nice upswing in terms of our funds under management and our returns. And I think we are well positioned to capture some of the upside that you see in Asia. And I think as a proxy for seeing that growth, we're be a good company to take a look at.
Why should investors invest in STAG Industrial today?
I think what the market is missing is the fact that not only we accelerated our internal growth, our cash same store, it's here to stay. It's sustainable. At IPO, it was 0. 7 years ago, it was 1%. Last year, 5%. This year, guidance 4 to 5%. That is a re-rating quality. That is a big driver. We're retaining cash flow. If you had asked people, what do you think about STAG 10 years ago, they would have said a good allocator of capital. I think if you ask that question now, people who are paying attention would say good industrial operator. I think the market is starting to come around to that. That's a huge value proposition, and that's the reason why you would want to get into STAG right now.
I'm here at the Citi Global Property Conference with Jay Sugarman, CEO of Safehold, and I have one question for you. Why should investors buy your stock today?
Safehold is the dominant player in a new asset class that I believe will become one of the core asset classes for all real estate investors.
Why do you think that investors consider your stock today?
Well, let's start with our track record to date. It's been about 5 years since our IPO. Since our IPO, the S&P and NASDAQ have each returned between 48 and 49%, both of them. Not bad, but not great. We returned 110% since our IPO. So we have a proven track record of creating value. But then let's take 2023. We announced our guidance here a week or two ago with our earnings. The midpoint of our guidance calls for 10% growth in adjusted funds from operations or distributable cash flow. Compare that to the consensus earnings per share growth for either the big REITs, which is generally between 3 and 5%, or about half to a third of what we're indicating, or the S&P 500 overall, which is maybe 2% and maybe lower. So combining the earnings growth of 10% with our current dividend yield, which is about 4.5%, if you add those two numbers together, it's a decent proxy, not fail-safe, or foolproof, I should say, but a decent proxy for what kind of total return you might be able to expect. So 14.5%. Now take the earnings growth in the S&P 500 at 2%, the current S&P dividend yield of 1.5, that's up to 3.5%. So which would you rather have, 14.5 or 3.5? And then, of course, when you get to 2024, the question is, can VICI continue to grow? And I think, based on our track record to date, we're pretty resourceful at finding and executing growth when it's there for us.
And just want to ask you, why should investors consider investing in your stock today?
Well, listen, we've got some very high quality assets. Over 60% of the company is upscale extended stay. The results speak for themselves. We've got the highest margin in the business. We've got the highest absolute RevPAR of all the select service hotel REITs. And we've got some great embedded strong growth for 2023 and going forward.
And my understanding is that your stock is also priced at a discount with net asset value at the moment. Do you think that's...
I think that's right. That's a great primary reason, with a 11.5 times multiple, roughly. The implied cap rate is about 8.5%. It's just way wrong relative to what private market values really would be for our assets.
Just want to ask you, why should investors consider investing in your REIT today?
I think IRT has a history of performing and doing what it says it's going to do. And we've delivered outstanding growth for our shareholders over the past few years, and we're going to continue to do that. We have an amazing value-add redevelopment pipeline that'll continue to provide that alpha that all your investors seek and want your portfolios.
Why should investors consider investing in your stock today?
We provide the most affordable housing in Canada, where in Alberta, our largest market, over 90% of our residents pay less than 30% of their household income to rent. And as a result, affordability is what we have identified as a mega trend. Affordable housing's essential for our economy, our communities, and we lead in affordability in Canada. We also lead in our current evaluation is far below replacement cost, and so our units right now present exceptional value for investors to buy apartments at well below replacement cost and to contribute and support an affordable housing provider to continue to do that. Together, building great affordability and value for investors. Win-win.
So which REIT is my favorite out of these? If I had to pick one, it would be STAG Industrial, ticker symbol STAG. The reason why this one will be my favorite is because I think that it provides the best combination of value, resilience, and growth. This is a REIT that owns very desirable industrial properties with rapidly growing rents because its current rents are deeply below market. It's able to re-sign leases at roughly 20% higher higher levels. And so this is driving a lot of organic growth. The company's balance sheet has greatly improved in recent years. Its payout ratio has come down. And despite that, the share price of the company is still heavily discounted, in large part because the dividend growth of the company has been slow in the past. But now we expect this to change. As you saw earlier, I talked to the CFO. He's giving very strong hints that the dividend is going to be hiked quite significantly going forward. And I think that this is going to change the whole market sentiment of the company. Today, STAG Industrial is priced at roughly 15 times FFO. In comparison, some of its peers are priced at closer to 25 times FFO. So there's a pretty large spread in there. And I think that as its dividend growth now accelerates closer to that of its peers going forward, we're going to see its valuation gap close down. And if STAG's valuation just rises to, let's say, 20 times FFO, you get 25% upside from here. While you wait, you earn a 5% dividend yield. The cash flow of the company is growing by 5 to 8% per year. And so you have a clear path to double-digit total returns. And so I think that the risk reward is very compelling here because you get this attractive return profile with a relatively safe REIT. This is a REIT that again has a strong balance sheet, low payout ratio, desirable assets, growing rents, a management team that's very friendly to shareholders. And so all in all, the risk reward is very compelling here, some of the most compelling in the entire REIT sector. Now, if you want to access all my other management interviews and also my entire REIT portfolio, feel free to join my REIT newsletter for a 2-week free trial. I'll put the link somewhere in the description of this video. And again, if you could like this video, that will help me a lot. Thank you very much. See you at my next one. Bye-bye.